Welcome back to another episode of Trending FAQs. Today we will be talking about, how does hyperinflation happen? And is hyperinflation coming? Be sure to hit that subscribe button and leave a like and share with friends and family so you don't miss any of our future uploads. What defines hyperinflation? Hyperinflation is a term to describe rapid, excessive, and out of control general price increases in an economy. While inflation is a measure of the pace of rising prices for goods and services, hyperinflation is rapidly rising inflation, typically measuring more than 50% per month. How does hyperinflation happen? Although hyperinflation can be triggered by a number of reasons, here are a few of the most common causes of hyperinflation. 1. Excessive money supply. Hyperinflation has occurred in times of severe economic turmoil and depression. Depression is a prolonged period of a contracting economy, meaning the growth rate is negative. A recession is typically a period of negative growth that occurs for more than 2 quarters or 6 months. A depression, on the other hand, can last years but also exhibits extremely high unemployment, company and personal bankruptcies, lower productive output, and less lending or available credit. The response to depression is usually an increase in the money supply by the central bank. The extra money is designed to encourage banks to lend to consumers and businesses to create spending and investment. However, if the increase in money supply is not supported by economic growth as measured by gross domestic product, otherwise known as GDP, the result can lead to hyperinflation. If GDP, which is a measure of the production of goods and services in an economy, isn't growing, businesses raise prices to boost profits and stay afloat. Since consumers have more money, they pay higher prices, which leads to inflation. As the economy deteriorates further, companies charge more, consumers pay more, and the central bank prints more money, leading to a vicious cycle of hyperinflation. 2. Loss of confidence in the economy or monetary system. In times of war, hyperinflation often occurs when there is a loss of confidence in a country's currency and the central bank's ability to maintain its currency's value in the aftermath. Companies selling goods within and outside the country demand a risk premium for accepting their currency by raising their prices. The result can lead to exponential price increases or hyperinflation. If a government isn't managed properly, citizens can also lose confidence in the value of their country's currency. When the currency is perceived as having little or no value, people begin to hoard commodities and goods that have value. As prices begin to rise, basic goods such as food and fuel become scarce, sending prices in an upward spiral. In response, the government is forced to print even more money to try to stabilize prices and provide liquidity, which only exacerbates the problem. Oftentimes, the lack of confidence is reflected in investment outflows leaving the country during times of economic turmoil and war. When these outflows occur, the country's currency value depreciates because investors are selling their country's investments in exchange for another country's investments. The central bank will often impose capital controls, which are bent on moving money out of the country. 3. Increase or higher than normal demand. When there is a surge in demand exceeds supply, sending prices higher. This can happen due to increased consumer spending due to a growing economy, a sudden rise in exports, or more government spending. Is hyperinflation coming? About 20% of all US dollars were created in the year 2020. This causes some people to believe the US is headed toward hyperinflation due to past and possible future government stimulus behavior. However, experts in general do not believe hyperinflation is likely. Thanks for watching. Please subscribe, like, and share. Also drop a comment down below letting us know what you think.